Imagine walking into a beautiful old church. Quiet. Peaceful. People sitting patiently, thinking long-term, about eternity. Now imagine that right next door, attached to that same building, there's a neon-lit casino. Bells ringing. Lights flashing. People screaming for the next big win. That's not a metaphor I made up. That's how Warren Buffett, the single most successful investor in human history, described the stock market itself at Berkshire Hathaway's 2026 annual meeting. He told CNBC that markets have always been like a church with a casino attached, but the casino's side has gotten a lot more attractive lately. And then he said something that should stop every single retail investor in their tracks. We've never had people in a more gambling mood than now. If the richest investor on earth, a man worth over $150 billion, who has been doing this for 6 decades, is worried about how people are behaving in the market right now, shouldn't you be paying attention? By the end of this video, you'll know exactly which side of that building you're standing in. The church or the casino. And more importantly, I'll show you how to make sure you never accidentally wander into the wrong room again. Let's get the facts straight first, because this comment didn't come out of nowhere. This was said during the 2026 Berkshire Hathaway annual shareholder meeting in Omaha, a historic one, by the way, because it was the first annual meeting led by new CEO Greg Abel, with Buffett having stepped back from the top job at the end of the previous year. But even though he's handed over the reins, Buffett still showed up. Still talked to CNBC. Still didn't hold back. He said financial markets are increasingly being driven by speculation rather than long-term investing. And he didn't just mean it in a vague, philosophical way. He pointed to something very specific and very modern, the explosive growth of one-day options. These are options contracts that expire within 24 hours. People aren't buying these because they believe in a company's 10-year future. They're buying them because they think a stock might twitch up or down by tomorrow morning, and they want to bet on that twitch. Buffett didn't mince words about what that actually is. That's not investing. It's not speculating. It's gambling, just totally. And he went further. He also took aim at prediction markets, platforms where people bet on real-world events, from elections to geopolitical outcomes. He even referenced a real, ongoing case where someone allegedly used insider government knowledge about a military operation to make a 6-figure profit betting on a prediction market. To Buffett, that's not a feature of modern finance. That's a symptom of a sickness. Casino.org. Here's the number that really tells the story, though. Buffett mentioned that in his 60 years in business, only 5 of those years were what he called really juicy, meaning genuinely full of great opportunities. Fortune. 5 years. Out of 60. That tells you something critical about how real investing actually works. It is not constant action. It is long stretches of patient waiting, punctuated by rare moments of real opportunity. Now here's where Buffett doesn't just talk, he shows you, with his own money, exactly what he believes. Berkshire Hathaway is currently holding a record $397.4 billion in cash. Let that number sink in for a second. That's not a typo. Nearly $400 billion, just sitting there, not invested in stocks, not invested in new businesses. Why would the greatest investor of all time leave that much money on the sidelines? Because despite running Berkshire's massive cash pile up near $400 billion, Buffett still says he doesn't like the prices he's seeing in the market today. This is the part most people get backwards. They think investing means always being in the market, always buying something, always doing something. But Buffett's entire career proves the opposite. The skill isn't in constantly acting, it's in recognizing when the casino is too hot, the chips are too expensive, and the smartest move is to simply not play that hand. He's made it clear that this isn't a phase. He favors a disciplined, long-term approach, and going into prediction markets or short-term trades simply isn't part of that philosophy, no matter how tempting the headlines around him are. Think about the social pressure involved in that. Every financial news channel, every app notification, every group chat is buzzing about some stock that doubled overnight, some option play that turned $500 into $50,000. And the world's most respected investor is sitting there with $400 billion, watching all of it, and choosing to do nothing. That takes a level of conviction most people simply don't have. And that conviction is exactly what separates an investor from a gambler. Let's make this really concrete. What actually separates these two types of people standing in the same market? The gambler asks, "What's going to move in the next 24 hours?" The investor asks, "What will this business look like in 10 years?" The gambler checks their portfolio 15 times a day, heart racing with every red or green tick. The investor can go months without looking, because they already know what they own and why they own it. The gambler buys because a stock is moving, chasing momentum, chasing hype, chasing a number on a screen. The investor buys because a business is undervalued relative to its real, underlying worth, and they're comfortable being the only person in the room who believes that. The gambler needs to be right immediately, or the position feels like a failure. The investor is fine being wrong for years, as long as the underlying logic is sound, because they understand that the market can be irrational far longer than most people can stay patient. One-day options are the perfect symbol of the gambler's mindset. You're not betting on a company. You're betting on the next 24 hours of random noise. As Buffett put it, there's nobody who can genuinely explain why they're buying an option that expires in one single day, unless they have information nobody else has, which is usually illegal, not impressive. Compare that to Buffett's own famous approach. Back in 1999, long before any of this casino-style trading existed, he talked about putting $10,000 into smaller, overlooked companies and simply letting the power of compounding work over decades. No charts. Number 24-hour bets. Just patience, independent thinking, and trusting your own judgment over the noise of the crowd. That philosophy hasn't changed in over 60 years. The casino has just gotten louder. Now let's bring this home for those of you watching from India, because honestly, this casino mentality isn't just a Wall Street problem. It's showing up right here on Dalal Street too. Look at the explosion in futures and options trading volumes on the NSE over the last few years. Millions of new retail traders entering the derivatives segment, many of them young, many of them treating index options like a quick money lottery ticket rather than a tool for serious investors. SEBI itself has repeatedly flagged how a huge majority of individual FNO traders in India lose money. That's not an opinion, that's the regulator's own data. And it's the exact same casino behavior Buffett is warning about, just wearing a different jersey. So what does the church side of investing look like for an Indian retail investor? It looks like a disciplined SIP into a good mutual fund or index fund tracking the Nifty 50, continuing every single month, through rallies, through crashes, through boring sideways years, without panic, without euphoria. It looks like picking a fundamentally strong business on the Sensex or Nifty, understanding what it actually does and why it makes money, and being willing to hold it for 5, 10, 15 years, the same way Buffett held Coca-Cola, or American Express, or Apple. It looks like having the patience to sit on cash when valuations across the BSE look stretched and silly, rather than feeling forced to chase a rally just because everyone in your friend circle is bragging about their latest options trade. India's stock market is still in its growth story. That's exactly why the casino temptation here is so dangerous. The long-term cathedral of wealth building is genuinely available to you. You don't need to gamble your way there. You can compound your way there. So here's how you actually apply this Buffett wisdom starting today. 1. Ask yourself, honestly, why you own every single thing in your portfolio. If your answer is, "I think it's going up," that's a gambler's answer. If your answer is, "I understand this business and believe it's undervalued," that's an investor's answer. 2. Stop checking prices constantly. The more you watch, the more you're tempted to act like a gambler reacting to every spin of the wheel, rather than an investor thinking in years. 3. Build your own cash reserve, just like Berkshire does. You don't need $400 billion, but having dry powder ready for when real opportunities appear, instead of being fully invested at all times, is one of the most underrated habits in all of investing. 4. If you're tempted by short-term options or quick speculative trades, ask Buffett's own question: can you actually explain, in one clear sentence, why this specific bet will work, based on real business value? If you can't, you already know which room of the building you just walked into. Warren Buffett has seen markets through wars, crashes, bubbles, and booms across 6 decades, and even now, even after stepping back as CEO, he's still warning us: the casino has never looked more inviting, and never been more dangerous. The question isn't whether the casino exists. It always has. The question is which door you choose to walk through, every single time you make an investment decision. Are you investing, or are you gambling? If this video helped you see the difference clearly, hit subscribe, because every week, we break down what Buffett and Munger are really teaching us about building real wealth, especially for investors right here in India. Drop a comment: are you the gambler or the investor? I'd genuinely love to know. I'll see you in the next one.